Welcome back to our special program, the Investment Summit. During this hour, we are talking about tech stocks. Joining me here on stage at the Los Angeles Convention Center are Alan Harris of the Munder NetNet Fund, Kevin Landis of the First Hand Technology Value Fund, and Andrea Williams, Internet Analyst for Volpe Brown Whalen. Andrea, let me begin with you. People are talking about the Internet sector as if it's this huge mania going on, but you disagree.
Well, people love to compare what's happening on the Internet to the tulip bulb phenomenon, and I think it's very dramatically different. I mean, what's similar is the unbelievable growth in a very short period of time, but tulip bulbs were not revolutionizing the world, and the Internet is. And what we see happening on the Internet is, I think, unprecedented in our history. It's probably the most significant revolution, certainly this century, and the Internet is becoming a necessity in people's lives, and that has very profound implications for the magnitude of the opportunity.
But how do you value the Internet stocks? I mean, so many people criticize the fact that the Internet companies are not making any money, and yet the valuations compared to some of the other companies in the S&P 500 index, which are generating healthy profits, healthy revenue, and their valuations are much lower. So how are we supposed to value these stocks? Do we look at revenue growth? Do we look at traffic? What do you look at?
I think that the best proxy for growth is just looking at revenues. These companies are not, for the most part, profitable, and they won't be for some period of time. They're able to go public at a much earlier stage than many other companies, and really what you're buying here is a concept, and that has a lot of risk to it, because right now people are feeling very good about the opportunity on the Internet, but that could change very quickly, and people will these stocks are incredibly volatile because people don't, they're not sure what to expect, and they buy events, they buy any indication that the market share is growing, that the leadership positions are changing, and their horizon is very long term. If that changes, then we see a big pullback, as we've seen over the last couple of weeks.
Is there a time that we should look for that earnings will become important for the Internet companies, and how far away is that?
It depends on which company you're speaking about. We look at business models right now with an expectation that our companies will generate earnings a few years out. But we don't necessarily think our pure-play Internet companies have to generate earnings immediately. A good historical precedent to this is the cellular telephone. Cellular telephones were commercialized in 1984. Most of the cellular telephone companies never made a dime of bottom-line earnings for more than a decade later, yet they were building substantial shareholder value throughout that period, most of which were very good stocks, and one of the pioneers in the cellular industry, Craig McCaw, sold out for $12 billion 10 years later. So that's called building shareholder value, and we're really paying attention to which of our companies are building shareholder value. Ideally, we'd like to have profits come 2 or 3 years out, but if they're doing the right things for shareholders, we don't mind waiting a few extra years for that return.
Kevin, looking at technology overall, do companies have to be somewhere associated with the Internet in order to survive?
Maybe not in order to survive, but I think to be interesting, to be exciting. You know, high tech is always has something that's sort of blossoming, that's really exciting about it. And we talked earlier about the PC giving way to the Internet. The Internet is clearly it right now. I challenge anybody to name something exciting that's going on in high tech right now that's not the Internet. There are some things out there, but you don't hear about them because the Internet is in everybody's face. It's so huge. It's the thing that is happening right now, and there are a lot more companies associated with it and benefiting from it than you might tell just by looking at all the .com stocks.
Alan, what's the best way to play the sector?
There are several different ways to play the sector. Our investment philosophy is to look at 3 different types of Internet stocks. The first are the pure-play Internet stocks, the ones that get all the press, the Yahoos, the America Onlines, the Amazons. Then there's another category of companies that we call the hybrids. These are companies that have earnings, have businesses elsewhere, yet have gotten into the Internet as a way to layer on to their growth. And then the final way to play it is the technology anchors, companies like Cisco, Microsoft, WorldCom. These companies would be just fine on their own, but the Internet adds another layer to their long-term growth.
Some people have said that in the summertime, technology slows down, and that during that time, tech stocks trade down. Is that what you're looking for?
Typically, summer is a weak period for technology stocks in general. One of the reasons for that is because a lot of the companies have European exposure in technology, and most of Europe goes on vacation in late July and early August for the whole month. So that's a typical period of weakness in overall technology. We're not sure exactly how that plays out, but on average, over a number of years, technology typically does get weak in the summertime.
So, Andrea, for those of us who wanted to buy internet stocks, should we wait for better prices later in the summer?
I think you have a difficult time trying to time the market here. These stocks have, most of these internet stocks have pulled back 20 to 40% in the last several weeks. I think they look attractive at this level, but if we think that the market will continue to sell off a little bit over the summer, I think you probably will find a lower entry point. But over the long haul, if you're a long-term investor, if you buy the stocks today, I feel very confident that you can see very attractive returns in the industry leaders.
Kevin, tell us about your fund. How is it mixed up? What portion is devoted to internet? Where else is the money?
The bulk of the fund is invested in stocks that benefit from the internet, that are basically technology providers, but very, very few of the .com names. We own America Online in our Technology Leaders Fund, and we own a few of the smaller internet specialists in our Tech Innovators Fund, but Tech Value owns basically no pure internet stocks, but healthy doses of companies like PMC Sierra and AMCC, who are supplying the Ciscos and Lucents, who in turn are supplying the networks that are carrying all this traffic. So the internet, I believe, is clearly the engine that I'm watching to drag our stocks north.
Andrea, were you at the AOL analyst meeting the other day in Washington? And if not, what do you think about AOL's broadband strategy, that being the company's push to offer internet access, high speed?
I was at the AOL Investor Day, and that was a significant topic of conversation. It's been one of the reasons why AOL stock has been depressed over the last couple of months.
How was the meeting?
The meeting was very well attended. It was very positive. I think they did a good job of level setting. There's been, I think, excess concern about what their broadband strategy would be, particularly on the cable access side. I think they are correct in their assertion that broadband is an upgrade to narrowband, and at least over the next several years, and that there's clearly nobody else out there who has more customers to upgrade than AOL. They have 19 million subscriber households, dwarfing everyone else in their group. So they are, in my opinion, the best partner for any of the technology vendors who have pipes and need lots of content to pass over those pipes.
What's your target price on AOL, or do you have one over the next, say, 6 or 12 months?
We don't have a target price for AOL. It is, we think the stock can return to its highs, but a lot of this, again, is very emotional and depends on how people want to view technology, or internet stocks in particular, at that given point. Again, over the long run, we think AOL is the best positioned internet company. It's one that that should be a core holding, and you pick your entry points, but that's the best company, I think, to own in the internet.
Kevin, I noticed you giggled when I asked Andrea for a target price on AOL. What was that all about?
I wouldn't characterize it as giggle, but maybe a smirk. We're lucky. We're on the buy side. We don't have to name targets. So if we name targets and our favorite stocks blow right through them, we can just shut up about it and let the stock climb north. And I've tried to set targets a number of times for, in particular, our biggest stock, PMC Sierra, and it just keeps blowing right past them. And not that it's getting much multiple expansion. The fundamentals are just ramping that fast, and that's kind of nice. It is dangerous and to try to set a target price on a sector that's so exciting.
Right. Okay. Well, you're a good sport, and thank you, Andrea, as well. We're going to take a quick break, and when we come back, we will continue our discussion on internet stocks and how wide the web sector should be in your portfolio. Don't go away. We've got a lot more ahead. Welcome back to the Investment Summit, our special coverage of the 3rd Annual Los Angeles Times Investment Strategies Conference. During this hour, we are strategizing about technology companies. With me are money managers Alan Harris and Kevin Landis, and internet analyst Andrea Williams. Let's get back to broadband. We were talking about AOL's analyst meeting couple of weeks ago and the company's broadband strategy. You just took a survey during the break. Why don't you do that? Tell us what you were just saying.
Sure. We took a brief survey of the members of the audience, and we believe broadband is very important for the growth of the web, to get the full experience of the web. We took a survey of how many people in our audience in California had broadband to the home, defined as cable modems or DSL, and it was probably about 2% of the audience.
And explain broadband.
Broadband is just basically a faster way to get the web in your home or at your business.
In other words, like you're at work and you access the internet very quickly, well, you want that at home.
Exactly. And it's only 2% of the users in this room. Nationwide, only 1 million households have broadband in the home, which we believe only 1 million households are getting the full experience of the internet in their homes.
What companies are poised to benefit from broadband?
There are a couple. Some of the leaders are the cable modem providers like Terrion and Com21. From the service perspective, a company called At Home, which is a service provider for cable modems and broadband, with an excellent management team, is another one.
Kevin, any additionals?
Well, on the DSL side, Aware is one of our holdings. AWRE is the ticker, and Aware gives the DSL technology that allows you to build a cable modem, or DSL modem, that brings the information out in and out of your home much faster. The other thing I should point out is that once we have broadband to everybody's home, that's going to stimulate a torrent of traffic, and there's going to be yet another build-out in the backbone. And so on the backbone, what that means is more fiber optics, more of the photonics companies like Uniphase and Ciena carrying more and more information on light. And that's going to be the next domino to fall once we get broadband to everybody's home.
One of the other panelists, actually, in another panel that I did earlier, also mentioned Uniphase in a similar regard. Now, Andrea, you have 3 strong buy rating stocks. You have a strong buy on AOL, CNET, and Lycos. We spoke about CNET and AOL. Tell us about Lycos.
Sure. Lycos is one of the top portal companies, and in that group you have Yahoo, Excite, Infoseek, and Lycos. Recently, they ended the proposed merger with USA Networks, with Barry Diller's company, because of concerns over the financial terms of the transaction. Strategically, we actually thought it was an interesting acquisition, but financially the market did not like it. We think this actually opens up Lycos to conversations with another media partner, which we think they'll likely find a partner in the second half of the year when the company becomes poolable. But in the meantime, Lycos is and remains the fastest growing portal. Their traffic growth has been absolutely phenomenal over the last 12 months. They, in fact, surpassed Yahoo last month in terms of their total usage. This is a company that we think is exceptionally well managed. We think there's going to be a tremendous flow of very good news this quarter to come out of the company. We think that's likely to drive the stock.
And basically, the company, the way I hear you saying it, is still in play.
Yeah, we think they're having conversations with various folks. I don't think any deal is imminent. Again, I would put it towards the back end of the year. We think ultimately they will need to have a media partner for the promotion and the content as broadband becomes more of a reality, but that's not a real near-term necessity for them. Over the long run, they're likely to find a partner, and they're one of the few very heavily trafficked sites that does not have a partner. There are many more traditional media companies out there who need, I think, and want to partner with a company like Lycos. So I think they're in a very attractive position.
What about consolidation in the internet? I mean, most people believe that all of these companies can't possibly survive on their own. Do you think we'll see further deals, and are there any companies that come to mind that you think either may be vulnerable to a takeout or perhaps looking to get into new areas of business and looking for a deal?
We think convergence or consolidation will continue to accelerate over the next 12 months. The companies that are best positioned are those that have market leadership, that own customer relationships, which is going to become even more important. I think attract a lot more attention. This is somebody like an E-Trade, or even a CD Now, which I think on a fundamental basis is struggling. They're getting a lot of their market share taken away from them by Amazon, but they do own a lot of customer relationships. So they may be attracted to somebody like a Tower Records or somebody who wants to get in, a Time Warner, who wants to get into that sector. We do expect to see a lot of consolidation among the industry leaders in the second and third tier names, but there's certainly a lot of smaller internet companies out there that don't have strong underpinnings and don't have anything that's really proprietary or unique, and I think are not attractive acquisition candidates. And when these stocks run up based on acquisition rumors, I think there's not much substance to that.
So it sounds like from an investment standpoint, stay with the leaders.
Yeah, absolutely. I think that investing in the leaders it's the safest strategy in the internet, and investing in the internet is not necessarily safe.
Okay.
You're very generous in terms of definition.
We have a lot more to cover. We will take a quick break, but when we return, we're going to start taking questions from our studio audience. There are about 2,000 people here, and we're going to try to take as many questions as possible. Stay with us. Welcome back to our special program, the Investment Summit, the LA Times Investment Strategies Conference. I'm Maria Bartiromo. We are talking tech stocks with portfolio managers Alan Harris and Kevin Landis and internet analyst Andrea Williams. As I mentioned, there are about 2,000 people here with a lot of questions in our audience, so let's get right to them. On the right, we have our first question. Yes, please go ahead.
Hi. The summer is a long time away from now in a day trader's life. If you have a stock like Yahoo and you've bought it high on margin, should you worry about it or sweat it out through the summer?
Andrea, how about tackling that one?
Well, I can talk about the fundamentals of the company, which not really from a day trader perspective, and maybe someone else will want to address that angle. But Yahoo, I think, is clearly one of the dominant companies on the internet. They're doing an excellent job of giving people as many reasons to come back to Yahoo and stay even longer periods of time. And I don't see that trend ending anytime soon. So I'm comfortable with Yahoo in the long run. As far as tomorrow, should you sell the stock tomorrow? Maybe one of these guys would want to take that question on.
Alan?
I pointed out earlier that historically summertime is a weak period for technology stocks. Internet stocks follow a very interesting trading pattern. Within a quarter, there are, of course, 3 months. Usually the third month of the quarter is a very strong month for internet stocks. The second month of the quarter, as people anticipate very good earnings and fundamentals coming out of results, the second month of the quarter is usually a very weak month. So we're just about complete through the second month and into the third month, which is historically a strong month, but it's a pattern that's only been evident for a few quarters, and the internet group's not old enough, per se, to have summer in it, so I'll show you both sides of the coin.
Uh-oh. One area that we mentioned when we were in the break was services. You and the two of you, actually, both like services companies. Tell us about them.
Well, if you think of it this way, the race is not always to the swift, but that's the way to bet. The companies that get on the web first, ahead of their competitors, tend to do better. If there's going to be lots of companies that aren't necessarily techno-savvy companies rushing to get on the web, one way to speed things up is to outsource your web presence. And you go to a web hosting firm like Exodus or Globex, and they take care of a lot of your needs, and they get you up to speed quicker.
Alan, you agree?
We definitely agree. The first thing any web-based company needs is people coming to their website. The way they get that is usually through the second thing, which is interesting content, pages that are interesting to investors and to users. And once they get all that traffic looking at that content, they need somebody outside of their core competency to manage it, like the web hosting firms that Kevin mentioned.
Okay. Our next question. Yes, sir.
Thank you, Maria.
Sure.
Would the panel discuss Broadcom, please?
Broadcom?
Broadcom is sort of a blue-chip member of the peer group that I talked about. There's a handful of stocks that are basically internet chip companies, not just PMC Sierra and AMCC, but also Triquint, Vitesse, Broadcom, Transwitch, and a few others. Great company, great story. The problem that I have with it, and the reason that we haven't purchased it for the fund, is that it's the most expensive stock in the group. And a lot of the reason that they have such a good valuation is they have the sizzle of being a cable modem company. Something to watch out for down the line is that Intel just bought their #1 competitor over in the networking space, Level 1 Communications. So you should look for, in about 6 to 12 months, a lot more competitive pressure, I think, coming from Intel.
Another question on the right. Yes?
invested in a stock in a company called Vizio, which is a software company. And I wondered if you had an opinion about them and if you had any holdings in your funds.
Do you own Vizio?
We do not own Vizio. I can't comment more than what they do, so we don't have any holdings. It's not really a pure internet name, so we don't have any.
Kevin, do you know the company?
I don't really have a strong opinion on Vizio. We don't own it.
Andrea? No. What do you like in software, while we're on the subject of software?
Well, I'll pound pervasive software again. A little company that gives you web applications that allows you to display the information to the people who visit your website with much more flexibility. And we recently hired another person in our MIS department, and we're a pretty small company, just to do programming in their Tango programming language. So we use it, and we like it a lot, and liked it so much we bought the stock.
Okay, sorry about that. Our panel did not know your company. Next question. Yes, please.
What do you think about CMGI as a way to play the internet even at these prices, and also SoftBank, which is a Japanese company that has a similar strategy?
Andrea?
It's easier for me to comment on CMGI. I think it's a great way to play the internet. It's easier, particularly from an individual investor standpoint, because you are diversifying your risk somewhat. You're not betting on a single internet company, but rather a portfolio of companies. CMGI has a great track record. I think it's very well managed, and they do an excellent job of getting their portfolio companies to work together. So I think it's a very attractive stock to own.
How about SoftBank? Anyone?
SoftBank has a very interesting collection of assets. It's not as well known due to its Japanese heritage, but if you add up its assets of the stocks that it holds and aggregate that up into the entire company, it is selling at a discount, but it's not a really well-known name here in the States.
Okay. Our next question on the right. Yes, sir.
Yes, my question has to do with stock selection, not just technology, but stocks in general. As individual investors, we do a lot of research, and we avail ourselves of programs and services, both on the fundamental and technical side. I find that the correlation between the two systems is quite low, probably about 20% in my experience. And I wonder whether that's normal. The technicals being much more pessimistic than the fundamentalists.
Okay.
If that's the case, what kind of weight is one to give to both of these techniques?
Do you use fundamental or technical analysis? Which one?
The bulk of our investments are bottom-up fundamental stock picks. We do pay attention to technical analysis in our stock picking process. It is we use it more of a confirmation of the fundamental trends as opposed to just buying stocks on technicals.
Kevin?
We use zero technical analysis.
Really?
We are just plain old-fashioned roll up your sleeves, do your homework, fundamental stock pickers. And I just go back to Finance 101, where my professor says stocks trade on the basis of their future earnings, period. That's it. A reasonable multiple to future earnings. And if you can figure out, particularly in technology, what are the new products that are coming that aren't in all those historical financials that you're poring over, by the way, figure that question out. Figure out this company's going to make X number of pennies to the bottom line in 6 or 7 quarters. What are you willing to pay for that? That's my approach.
Andrea, do you use technical strategies?
Similar to Kevin, our analysis is based purely on the fundamental understanding of the opportunity the company faces and their execution capabilities.
Okay, let's take a quick break. We'll be right back with much more of our special coverage of the LA Times Investment Strategies Conference from the beautiful Los Angeles, right here on CNBC. To our special program, the Investment Summit. We're taking a look at tech stocks during this hour. Let's get right back to some questions from our studio audience. Sir, you had a question? Please.
Yes, as a subscriber to a cable internet service, I know how revolutionary it is to have that always-on fast connection. I was wondering if any of the panelists know about a small DSL company called M-Phase. The symbol is XDSL.
XDSL. Anybody? No.
No.
Okay.
We're involved in some of the DSL plays like Covad, Rhythms, and North Point, but that being a smaller company, we're typically involved in the biggest companies, but I'm not aware of it.
Thank you.
Okay. We have a question on the right. Yes.
Hi, Maria.
Hi there.
I have a question about Pacific Bell that was bought out by SBC last year. And Pacific Bell at one time was trying to get into broadband. Do you know anything about that? Would that be a good buy to buy stock in that company right now regarding their interest in broadband?
Kevin?
I'm trying to get broadband service from Pac-Bell right now, and I can't.
Really?
I know they tried, they were starting it, and then they may have abandoned it. So I'm not sure if they're still trying to get into that. So would it be a good, I have an opportunity to buy stock in them.
Right. Well, I don't have a specific recommendation on Pac-Bell, but I'll tell you that I don't own it, and living in the heart of Silicon Valley and not being able to get broadband access is fairly frustrating for me.
Okay. Our next question on the left. Yes, sir.
Yes, what do you recommend in the business-to-business e-commerce arena?
Andrea, any business-to-business e-commerce?
That's not my area of focus, so
Okay,
I don't have
Alan?
any recommendations.
One of our favorites in business-to-business is a company called VerticalNet. What they do is operate 35 verticals in different markets, creating trading communities between various businesses. They have first mover advantage in the space, and we think that business-to-business e-commerce is much bigger than consumer-to-business e-commerce or business-to-consumer, which gets all the press.
Kevin?
Our Technology Innovators Fund has a position in a company called Sterling Commerce, which has been in business-to-business software for some time. We also own shares of VeriSign because we think the affirmation function is a pretty key piece of technology there.
What about e-commerce in general? Should you just be going to the players in any particular industry, or is there one or two stocks that you can think of that are best positioned for e-commerce?
I think there are going to be a number of great little technology franchises that emerge from e-commerce. E-commerce is a huge trend. One of those I would put up there that you can hang your hat on it and say, for sure, people are going to do a lot of business over the web. And again, VeriSign, excellent company. Sterling Commerce, great company. There's a few others out there that are just absolutely going to be key enablers. It's all about databases and sharing database technologies.
Which stocks?
Well, if you want a big company, believe it or not, Oracle. Oracle has great exposure to the web, but they're already such a big company that their loss of momentum in their established businesses is hiding the fact that they have a great exposure to the web. Remember, websites and exchanging information, that's all about databases, and Oracle's a database king.
Alan, e-commerce ideas?
A lot of consumer-based e-commerce ideas might make some sense. Andrea might be able to talk about a couple of them. We focus on leaders in the space. Companies like eToys, for instance, would be a good example of a leader in a space.
Now, you mentioned earlier, Andrea actually made this point that the gap between Amazon.com and Barnes & Noble continues to widen. So do you think that eToys continues going higher, and it is actually too late for Toys R Us?
Well, it's a little early to say it's too late, but that's the way I would bet right now. I think eToys has done a very good job in the brief amount of time that they really have been on the internet. I think Toys R Us is just not going to be able to move fast enough to close that gap. It's not their core business. It involves an investment that would require losing substantial amounts of money. Most traditional companies we've seen so far have been reluctant to really make the kind of commitment that's necessary to establish market leadership position.
Wow. Kevin?
It's interesting. I think what you see in the Barnes & Noble and Amazon example is a good one. It's not so much that, me big, you little. It's the little guy got to the web first and learned faster. So a company in Toys R Us position could go out and hire people, say somebody from Amazon. That would change the situation completely. But I think it's the advantage that the internet companies have now is that they're right out there and they can sort of see and smell and taste and feel what that world is like, and they can adapt quicker than the other folks. So if you're in any business and someone's leapfrogging you with the web, you have to move fast, and that means not following them down that same learning curve, but finding a way to maybe hire somebody who's all the way down that curve.
Can you think of any other stocks that are leapfrogging as far as they got to the web first, even though traditional companies were there in that business many, many years?
I think now and going forward, it's any process that could be made much better by using the web to facilitate it. And I know people have talked about pharmacies and shopping for insurance or whatever. Think about what you waste time doing today, and if you couldn't save a lot of time using the web. And if that's the case, then someone's going to get rich making that happen.
That's a good point.
It's even a potential risk, I think, for a lot of the mainstream media companies. The news, you get it much faster on the internet, and I think we've seen that that's having an impact on television viewership, on a readership of newspapers and trade publications. It's not just on the commerce side, it's on the content side as well.
Very good points. Thanks very much. Okay, we're going to take one last commercial break. When we return, we will ask our tech experts for their #1 top tech pick for the next year. Stay tuned for more of the LA Times Investment Strategies Conference on CNBC. Welcome back. We're going to get to our panelists' top tech stock pick in just a moment, but first, let's take another question from the audience. I believe there's a question on the left. Yes, sir.
You have mentioned that there are several engines that drive the internet, and I was wondering if Macromedia could be considered one of those.
Kevin, Macromedia?
Macromedia, a software company that we don't own, but it's a good example of a company that's trying to carve out a niche for themselves, giving you the tools to make your website a lot better, and gone from being sort of a multimedia publishing software house to being a website tools house. But I don't really have a strong opinion on that stock. We don't own it.
Okay. Next question on the right. Yes, sir.
Hi, Maria.
Hi.
Faster internet access is a major concern. I'd like the panel's opinion about North Point.
North Point is one of the ways to get faster internet access. There are a handful of companies like North Point, Covad, and Rhythms are others, which allow you, they're doing what's called a smart build, deploying equipment in neighborhoods and in cities to get faster internet access. And we think companies like these, which are small and nimble, are going to get at faster internet access through the home on the DSL side more so than the big snail-moving telecom companies.
Okay, next question on the left. Yes, sir.
Yeah, first of all, congratulations to LA Times and CNBC for hosting an excellent conference. My question is your thoughts on market capitalization of blue-chip internet companies like AOL approaching an IBM, and how do you come to terms with that?
Okay, valuations. You knew it was coming. What do you think, Andrea?
Well, it's always a difficult question to answer because I can't give you a simple formula or point to any traditional fund valuation analysis and justify AOL stock price. I go back to what I think that...
I can understand there'd be more PEs because it's more growth, but when it approaches IBM market cap of like $180 billion, we're talking total value.
Right. And what people are buying is, again, is the opportunity. I think we cannot actually envision how big the opportunity is. Actually, at AOL's Investor Day, Bob Pittman gave, I thought, a good way to think about it. He pointed to the invention of the automobile, and when it was first rolled out, people thought, well, this is nice. It's sort of a niche-y type of thing, and what it involved once the prices came down is more people buying cars. It meant they could travel further. It meant the creation of suburbs. It meant strip malls. It meant all these different things that nobody could have imagined when the first car rolled off the assembly line. I think what we're looking at here on the internet is something similar. It's so big that we cannot really understand how big it is. What we're betting on is that the leaders today, such as AOL and Amazon, some of these others, are so well positioned that they will remain leaders as this market evolves. So is the 150, 180 billion, is that a good number or not? It's hard to say. My bet is that AOL still looks attractive, even though the market cap is as high as it is, because they're likely to be a leader in the future.
And we should point out that back then, you mentioned the auto sector, there was, 29, 35, 40 auto companies, only to be, 20 years later, the big three.
Right.
Let's get another question on the right. Yes, sir.
What do you think of Quest and Microsoft?
Quest and Microsoft. Who'd like that one?
I've heard of one of them. And in fact, we own Quest. You can, it's hard to go wrong betting on a big gorilla. and that's certainly Microsoft. And we own a little bit of that in the Leaders Fund because that's a safe way to own the company that you know is going to gobble up a big portion of whatever upside the industry realizes. Quest, on the other hand, is a great stock because they're fleet of foot. They've gone out and built a network and shown that with a higher cost of capital, they can build networks faster and better than the big boys like AT&T. So that's pretty interesting.
Next question on the left. Yes, sir.
Are there any foreign companies that you're looking at as high-tech plays?
Alan?
As far as foreign companies are concerned, we feel like we just mentioned Quest. In the telecommunications bandwidth deployment cycle, Quest is doing something internationally in Europe, but there are two fiber-based companies that operate internationally, Viatel and Global Telesystems, that are building high-quality fiber networks to take advantage of traditional telecom, data traffic, and internet traffic, and we feel like internet growth internationally is substantially behind where it is in the U.S.
Very quickly, to the right. Yes, sir.
Okay.
Your question.
Thank you, Maria. Would you please comment on Street.com and MarketWatch.com?
Okay, Andrea, do you own it? I mean, do you follow the Street.com?
I don't follow them formally, but clearly there are a tremendous number of financial-oriented websites that appeal to all sorts of professional investors as well as individual investors. Both of those two have established a good brands for themselves and attract a lot of traffic. I think it's early to say how those business models will pan out, but clearly the interest is strong on the investment front. And how will they respond if we enter a bear market? That's the other question.
Thank you. We do want to be quick because we want to get your top picks. Do you like the Street.com?
We are owners of the Street.com. We feel like there is a substantial online community that's very interested in getting their news in a progressive fashion through Street.com.
Kevin, you agree?
Talk to them all the time, but we don't own them.
Okay. Let's get your top picks. Andrea, your top pick for the next year. What do you own in technology?
I think AOL, CNET, and Lycos here for the near term.
Okay. Kevin?
I'll give you two, a big company and a little company. Big company will surprise you a little bit. AT&T. Ticker symbol T. That's kind of the awakening giant. I think what they're doing in the cable space is really interesting. It shows that they're paying attention. Little company, a company called Triquint, a gallium arsenide chip company, a big wireless exposure. And I think wireless is booming, and people aren't really noticing that yet because they're focused so much on the wired side of things. Triquint, TQNT. And we own a bunch, so...
Okay, Alan, what are your top picks for the next year?
One of my favorites I mentioned already is WorldCom. Here's a company that's top 10 or 12 S&P index constituent. It's growing cash flow at 40% right now, yet it's being valued substantially less than some of its competitors out there, as well as some of the big cap market leaders for the growth it's producing.
Okay, unfortunately, we have run out of time this hour for tech stocks. I'd like to thank our guests, Alan Harris, co-manager of the Munder NetNet Fund, Kevin Landis, portfolio manager of the First Hand Technology Value Fund, and Andrea Williams, consumer internet analyst for Volpe Brown Whalen. Thank you all for joining us. Have a nice day.
Hello from sunny Los Angeles, and welcome to this hour of our special program, the Investment Summit, the LA Times Investment Strategies Conference. I'm Tom Costello. For the next hour, we're going to help you be a better investor online. The internet has definitely taken off. More than 36 million households are now connected to the internet, and that is expected to grow dramatically by the turn of the century, which is just 6 months away. While it is obvious that the internet is changing our lives, it is also altering both the types of stocks we invest in and how we invest in those stocks. It's estimated that a quarter of all stock transactions are now done online. Here to talk about this, give us some advice on how to be a more successful investor online, 4 accomplished cyber surfers. First, we have Bill Burnham. He's sitting on my left. He is the e-commerce industry analyst for Credit Suisse for Boston and San Francisco, and the author of the book, How to Invest in Electronic Commerce Stocks. Here's his book right there. The next one is Tony Cook, the managing editor of Quicken.com, which is one of the leading personal finance internet sites on the web. Next, Walter Hamilton. He is a markets reporter for the Los Angeles Times who covers online investing issues And on the end is Andrea Williams. She is a consumer internet analyst for Volpe, Brown, Whalen in San Francisco. Welcome to all of you. Nice to see you here.
Thank you.
And we have a lot to talk about. This is certainly a subject that our audience cares deeply about. Bill, let me start with you. Back in 1991, most people had not even heard of the internet, no dream that they could possibly use it to invest. And lately, there's been so much written about the internet. How much has it really changed? How much we invest and how we invest? And is this just for a select and small group of people?
Well, you know, I'd say it's actually been a dramatic change across the board. You know, if you look, and you just go back a few years to 1995, when really online investing started, we've seen all of the major discount brokerages, traditional firms like Charles Schwab and Waterhouse, that used to take trades only at branches or over the phone. Those firms, just 3 years later, those firms, the vast majority of their trades are taking place online. So there's really been a wholesale migration of individual investors, especially in the discount industry, online. And that's had huge implications, not only for the discount brokerage industry, but really for individual investors who have gotten trades incredibly cheap relative to what they were paying, have much more information, and as a result, they're trading a lot more. And it's had a big impact not only on individual investors, on the firms that provide them, but also the market itself.
And traditional brokerages are scrambling, trying to catch up with all this.
Well, they're scrambling, but, you know, it's incredibly difficult for them because they're used to getting paid, you know, $400 or $500 a trade, and $10 a trade is a little bit less than they're used to.
Yes. Andrea, it seems that there is no going back on this. Internet investing seems to be here to stay. How fast do you think this is going to grow, and how quickly?
I think this is going to be one of the fastest growing sectors within the internet. If you consider the types of industries that are best suited for the internet, it's those that have information that changes frequently, where the demand or the passion for that information is high, and the market opportunity in general is significant. And on top of that, in this sector, we add that we're able to serve a population that has really been underserved in the past with $400, $500 trades. Now individual investors have access to information that only professional investors had access to before, and they have the ability to act on that at very low cost. So
much to the chagrin of traditional brokerages that like to guard that information closely.
Exactly.
Okay. Tony Cook, who's from Quicken.com, let's talk a little bit about who is actually investing. According to one study, the average investor out there, online investor, is a male, 39 years old, college educated, with a $60,000 annual salary. What is this doing for your business, and do you agree with those demographics?
Our demographics are a little better than that in that we have people who are about age 43, a little bit more split evenly between male and female, and their net worth is a little bit higher. We have literally millions of people who are keeping their portfolio online with Quicken.com, coming to check their prices on a daily basis, getting alerts to tell them you know, whether or not their stock has kind of hit their target price and so forth. And we have many people who on an almost daily basis are coming to get information, content, tools that'll help them make investing decisions and to make them more confident about making those decisions.
Give our audience some sense of how quickly your business has developed in this particular area. Can you give us a 6 month ago, 1 year ago, 2 years ago?
Well, 18 months ago when we got launched, we were obviously at 0 page views, which is the measure of how you know, kind of chart your audience. And now we're up to almost 190 million page views a month. So that's a lot of people looking at a lot of pages.
And who thought that financial information was boring, right? Walter Hamilton with the LA Times. It is not just the male who's 39 years old and college educated, is it? We have, as I have talked to many people here over the last 2 days, of a wide variety demographically of people who are involved in online trading.
That's right. It absolutely, it probably started with the males as you speak of, but I mean, even if you just look out at the audience today, just the people in this panel, I mean, it's demographic, it's young and old. You know, my father is now doing this, and my father is as technophobic as they come, and now my mother's like, what exactly are you doing, honey? I mean, and it really comes on all the way down, and people hear so much about it, they see the commercials, they see the articles, and they think to themselves, wow, there's a better way to do it. And I think that with the improvements in technology that have made it more user-friendly, women, older people who haven't used technology are much more willing to do so now.
What exactly are you doing, honey, if you lose money? And boy, that was a great idea, honey, if things go well, right?
Yeah, I just got married, and I'm waiting to start to hear all of those things happen, actually. Yeah, I mean, obviously, this is a bull market phenomenon to a degree. I mean, obviously, you know, when things are generally going up, it feeds all this. It feeds online investing, it feeds conferences like this, so forth. When there is a prolonged down period, I think it will abate to a degree, but only to a degree. I mean, I really think the switch has been flipped, And really now there's no going back. People have seen, what's next. When we saw a downturn like we had last year, you didn't see individual investors panicking. That was always the fear, especially online investors, do-it-yourselfers who don't have the broker to hold their hand. They didn't panic. They actually held the market up. And it's people like this in the room. We talk about people going crazy, but most people are very, very sane about it.
We have a lot of themes to pick up on there, Bill, but one point that he made, we had a liquidity-driven rally, really from Dow 3,000 to 8,000, and from Dow 8,000 to 11,000. The internet investor was a big factor, wasn't it?
Yeah, absolutely. I mean, internet investors have shown a willingness to buy stocks at prices that would make most people pretty nervous. But I think it's a lot of people signing off on the fact that there's a tremendous opportunity out there. And, the common joke is that a lot of online investing is people working at internet firms, buying stocks, internet stocks through internet trading firms. But I really think that this is a sea change in the way people invest. And think about, 10 years ago, if you wanted to get a real-time quote on a stock, or you wanted to get some research from a Wall Street firm, the only way to get that was from a full-service broker. Today, the average investor can go and get real-time quotes. They can often get very sophisticated information that people just didn't have. So it's really democratizing the market, and a lot of the old line firms don't like it, but that's just the way it's going to be.
There's another factor there. It's called CNBC. Have you heard of that? We're going to pick up on that. We're going to take a break. When we return, you want to trade online, but you don't know where to start. We're going to tell you how to choose an online broker right after the break. Stay with us. Welcome back to our special holiday program, the Investment Summit, the Los Angeles Times Investment Strategies Conference. I'm Tom Costello, and during this hour, we're helping you become a successful investor online. Here to help on stage, we have some internet analysts. We have Bill Burnham, Tony Cook, he's the managing editor of Quicken.com. Walter Hamilton, he's the online investing reporter for the LA Times. And on the end, we have Andrea Williams, the consumer internet analyst for Volpe Brown Whalen. And again, thanks to all of you for coming in today. Andrea, let's begin with you. There are more than 100 online brokerages right now, all vying for online business. Some offer high-end fees, low fees, research, no research, financial planning advice, what have you. What should an investor be looking for when picking an online broker?
I think it does vary by the type of investor you are and what you're looking for. If you're looking for a lot more information, a lot more of the hand-holding, or if you really just want somebody who can execute your trades, you're looking for reliability, the types of information that you need, access to research to help you make your decisions. And all these things, it's hard for you to analyze one specific broker against another. I think you need to rely on third parties to do that. There's a company called Gomez Advisors that rates these online brokerages across a number of variables, and I think that's an excellent starting point for investors.
Walter, does size matter? As we mentioned earlier, Charles Schwab has 27% of the market. Second, we have Waterhouse. Third is E-Trade. How important is size when you're trying to execute a good offer?
I think it's important to a degree, but only to a degree. I mean, Schwab doesn't want as much of the fast-paced intraday day traders as some of the other places. You have like NDB that says if you buy and sell the same stock the same day, it's one fee. They're shooting for the really active day traders. A company like Schwab isn't. The issue thus far has been, even though the commissions are relatively low across the scale, is reliability and power outages. If you've got a stock and you've got to sell, and that E-Trade or Schwab or whatever is down, you're really in some trouble. What I would suggest is once you do the general analysis of how much do you want to pay, things like that, really ask a lot about the 800 number. Ask them how they staff up in times of trouble. Ask them how they staff up and how quickly you're going to be able to get to that 800 number. There's no foolproof way. I mean, the worst thing is to be hit in a power outage, not be able to do something. And there's no way to guarantee that you're going to be able to avoid it. But that would be one of the questions you'd want to ask.
And in fact, it seems that all of these brokerages have had power outages or downtime. Who are the worst offenders? Who have you seen who seems to come up the most frequently?
Well, Well, I think E-Trade has gone down, has had at least the most visible power outages. There was one in which they were on a real big marketing stint in there. They were down for 2 or 3 days for periods of those 2 or 3 days. And we in the media, of course, wrote, at the same time they're advertising heavily, they were down. But, I mean, Charles Schwab, which is obviously the leader, has been down. And the problem is that, some of these are not built for the dramatic volume, both in share price and in number of customers that are coming to them. They're working their best, I'm certain. I mean, nobody wants these power outages to occur. And now you got the SEC saying, you have Arthur Levitt saying, look, this is one thing we're going to be looking for. We know you're advertising, and that's fine, but you better be able to come through with the goods. So large and small, large names, maybe a little bit better reliability, but it's no guarantee.
And these seem to be growing pains associated with it just about in any internet portal or site or whatever. I mean, AOL has had its share of troubles and seemed to rebound from them.
These guys are really on the leading edge of electronic commerce technology across the board. So it's not unsurprising that when you're growing by 100 or 200% a year and you're processing more transactions than really almost any other internet site out there in terms of full transactions, that they're going to have problems. That's no comfort to you when you can't get out of a stock that you want to get out of. But from a technology standpoint, it's actually pretty impressive they've kept up with the volume increases that they have.
That's right. I would definitely agree with that. I mean, nobody really complains dramatically, or it doesn't cost money or lawsuits when AOL is down for a couple hours, we'll sign on later. It's, these guys, right, your money's on the line. Otherwise, they've done a very good job in general terms of keeping up. They just haven't been 100%.
Tony, help us pick, or help us determine how we pick a good broker, because we've seen costs come down, but listen, some trades as cheap as $5, the most expensive about $27. How should we use price as a barometer?
Well, cheaper is not always better in the sense that you're looking for a good execution as well as these other services that you can, by the way, get on Quicken.com, the research and the tracking and so forth. The brokers...
and by the way, we should say Quicken.com, it may be starting your own online investing unit, right?
Well, we've toyed with it. We're not interested at the moment. There is discussion about after-hours trading, as you know.
Is that an internet moment, by the way, or is that a...
Well, it's a marketing moment,
okay.
We have the virtue, actually, on our site of being an objective source for people of information and data and tools, whereas the brokers are constrained because of the NASD rules as to what they can tell a customer. So we actually have the ability to be, we think, more honest and direct and objective in the information that we're providing. But anyway, when you're analyzing a broker, one of the things you want to account for is not just low price, but also execution, meaning, if you see the bid and ask on your screen, you want to get close to what the last trade was as opposed to what somebody might deliver for, a cheaper price, but not as good a price, when you're purchasing the security. So you wouldn't want to save $200 on a trade and then lose the $200 because they didn't get you a good price.
Sure. Andrea, so how do we determine, how do we find, or where do we get the research to determine which one we actually want to go to? And we have Gomez Advisors, which ranks Internet Brokers, ranks a small company called A.B. Watley in 6th place. It had been in 47th place. So I'm trying to determine, how do we find the research to determine which one is right for us, which broker is right for us?
As far as I know, Gomez Advisors is the most comprehensive service out there that rates the brokerages, and they move around a lot based on their performance from month to month. I think it's it's not moment to moment, although they do have some services that are more real time. I think that's the best starting point, and then it's based on your own individual experience. If you have problems and you are disappointed with the customer service, then that's something that would give you serious reason to consider changing.
My hunch is that most people in this audience and the television audience has an issue, or they have an issue, I should say, with security. Are you safe to go ahead and invest online, to release financial data online? Bill, what's your sense? Have we come far enough in terms of encryption to allow this safely?
Yeah, the security today is actually pretty good across the board, but I think you have to use the same kind of common sense that you use with sensitive information that you use in the physical world. Lots of people have ATM cards, and you have a special password that goes with that. You don't go around with it, taped on the back of your shirt, and you don't hand your card out to people. Same thing goes with the internet. If you've got a password, you've got a user ID, protect it like you were protecting money. and make sure that you're accessing a secure site. When you do that, the fundamental security mechanisms in place should protect you.
Okay, we have a lot more to talk about. We have to take a break, but when we come back, the internet not only changing the way we invest, it is also changing how we get information. We're going to take a close look at getting access to the vast array of information on the internet right after this. You're watching CNBC. And welcome back to the Investment Summit. I'm Tom Costello. I'm here at the very large Los Angeles Convention Center talking about investing on the internet. And joining me here, analyst Bill Burnham. We also have Tony Cook from Quicken.com, Walter Hamilton of the LA Times, and analyst Andrea Williams is here as well. So a great panel to begin our discussion again in this segment. Tony, your site, Quicken.com, offers a vast array of information. What do you find that your users are going to the most?
Well, we have, because we're a general personal finance site, we have everything from soup to nuts. But primarily, people are interested in investment-related information. We do have mortgage information. We do have tax information. We do have insurance information. But by and large, the people who are coming back for what we call on the internet the sticky services are the people who want to know today, how am I doing, tracking my stocks, my funds, getting updates on their prices, getting alerts about dividend splits, and other information relating to the question of how I'm doing today.
And these are not necessarily day traders, right? I think I read a figure that there are only 100,000 day traders in the whole country, and they get an awful lot of press. So this is mom and pop, in other words.
That's right. Yeah, we have some people who are hitting the quote button a lot, and then there are other people who are simply coming in, checking their stocks once a week, once a month, trading not as often, but trying to use the site, Quicken.com, to make the decisions to give them more confidence that they're doing the right thing at the right moment.
Okay, Walter, there are dozens of sites, of course. We have everything from sites that offer information, news, analysis, stock quotes, portfolio help, etc. What do you find are the most common internet sites or the hottest internet sites right now to get this kind of information for people who want to know about how they can help themselves financially?
I think what you've gotten is you've gotten to a level at which many of the leading sites all offer at least a generic set of services, everything from stock quotes to portfolio management to some degree, to stock screening of some degree or not. You can put in the variables that you want. I think that one of the more popular sites is Microsoft's MoneyCentral.com. I think it's gotten some good write-ups in some of the press, my paper and others, and they've poured a lot of money into it and a lot of resources into it. They have a very good stock screening program, for example, in which you can put in a number of variables. Some of the other sites only allow you to maybe 2 or 3 variables. They don't give you a lot of leeway to really hone down to the stocks that you want, don't give you some of the factors you want. That's a popular one. I think also now a lot of the people I talk to, they're really trying to go to that next level. There's a site called stocktables.com, which really gives more information than the newspapers can give, and you can go and get even more detailed information just on individual stocks. So it's really, again, trying to differentiate themselves a little bit from the base level that's out there right now.
Bill, you got a thing, you wanted to say something.
Well, I was just going to say, one of the most popular areas online now are these chat boards where individual investors come and post their ideas about the stocks. And it's interesting because, as Andre probably knows, we cover these stocks, and a lot of institutional investors will call me and say, what's going on in the stock? It's been up, it's been down. And it turns out that I go to the chat boards to see what the chat lines are saying about the stock. So they're actually not only important for individual investors, but important for institutional.
Do you want to know what the stock chat rooms are like? You know what they're talking about? Online chat discussions that essentially, in many cases, you have individuals who are hyping a stock, or they're trying to pump and dump a stock, or whatever the case may be. Constant online conversations going on all day with people all over the country, and stocks are moving on this conversation. It is amazing to see. You can see it on several sites. But Andrea, that brings up an important point. A lot of this information in these chat rooms can be wrong, can be misleading, can be self-serving, designed to pump and dump. What are you seeing?
I think there's very significant risk to relying on the chat rooms because you don't know what the incentive is of the people who are posting the messages. You don't know if they're trying to pump and dump or if this is real information or they're an insider, somebody at the company who is letting out company secrets. Sometimes the information is good, sometimes it's bad. So while I think it's useful as a tool and just another resource that you can go to see what people are saying about a particular stock, keep in mind that you get what you pay for, and you're not really sure the quality of that information. I think you complement that.
So how do you know? I mean, it's like having an online romance. You really don't know who's on the other end and what their agenda is. Not that I've ever had an online romance, mind you. But how do you know?
I don't think you can know. You don't know right now, and that's perhaps a very interesting opportunity for a good business idea for somebody if they can come up with a way to rate the quality of any particular poster.
Tony, you got some thoughts on that, or Walter?
Well, first of all, I think you should use the same due diligence you do when you read the newspaper, read a magazine, or even watch CNBC. You should be aware that people have an agenda or perhaps even a hidden agenda when they're recommending certain things, and you can use that same discretion when you're going to the message boards. Our message boards have tremendous value for people because it's a form of validating your opinions. You get some very insider kinds of information. We have, for example, fund managers who are coming to answer questions about their funds.
You know what? The computer's going to cut us off. I have to stop you for a minute. We're going to take a break. When we come back, questions from the audience, and we'll finish our thoughts. So stay with us. You're watching CNBC. And welcome back to our special holiday program, the Investment Summit. I'm Tom Costello, and during this hour, we're going online and trying to help you become a more successful investor on the internet. Joining me here on stage, once again, we have analyst Bill Burnham, we have Tony Cook of Quicken.com, Walter Hamilton of the LA Times, and analyst Andrea Williams is also here this afternoon, or this morning, depending on where you are in the country as you watch this. We're going to begin with our studio audience. They have a lot of questions about a very hot topic, and we begin over here. Go ahead, sir.
Yes, you mentioned the short-term problems such as being the online service being down. What about the long-term problems that you could face, such as information from the database that's out of date?
Who wants to handle that? Tony, you want to take it? I'm sorry, Walter, you had. Go ahead.
I'll be happy to take it. That's an interesting question, and you really do, in some cases, have to question some of the data. I mean, we really haven't had a lot of cases in which, I don't know of any lawsuits or actual complaints. Doesn't mean they don't exist, but I don't know about any that we've had in which people have said, well, I invested based on, your site that said this company was growing 30% a year and the company was actually losing money. But it is a good question that you raise, and because I haven't heard of it doesn't mean it doesn't exist. There are many sites out there that give similar, especially company fundamental information. It would be a good idea to check one against the other and make sure that they're fairly close. They might not always be accurate depending on the accounting and the data source, but you might want to check, right, one after another, make sure they're right. Good question.
Okay, sir, you have a question. Go ahead.
My question is, I would like to know how much can you rely on the analyst, and also how they get paid and by who?
Bill, how can we rely on you, and who pays you?
Of course you can rely on the analysts. Analysts, I work for investment banks, so does Andrea. My primary constituency is actually writing research for institutional investors. Some of our research is actually redistributed. In our case, it's redistributed through Charles Schwab. We are paid sort of a complex formula, but essentially we're paid in how well we service our clients, which include, and the vast majority of the institutional investors, companies like Fidelity and Scudder and Putnam, as well as how well we service the companies that do business with the firm, et cetera. So it's a fairly broad base, but our number one priority is putting out quality investment research for institutions.
And there are analysts out there who work for firms who have a large stake in some of these companies. So his question is relevant.
Yep, absolutely. And a policy that I take, and I think a lot of analysts take, I will not invest in any of the companies that I cover in my universe because it's too big a risk to have a conflict of interest when you're talking about a stock. I think you have to have a completely neutral position. So I set that as a policy, and a lot of analysts have very complicated ethical policies which they take to ensure that they don't have a financial motivation when they recommend or don't recommend a stock.
Okay, let's go to a question over here. I'm sorry, we're trying to get through as many as we can. Go ahead, sir.
Just congratulating the CNBC and thanking you very much for advising us financially. I'd like to know about the traffic, the very high traffic time that it may happen at times.
In other words, how long it takes to get online and which is the slowest particular broker or what have you. And by the way, every day on CNBC on Squawk Box, we do a traffic update to show you which is the slowest and the fastest online broker. But that's a good point. Why don't you handle that one, Tony? How do you go about that?
Well, are we talking about connectivity and how fast
Connectivity
it
and how
is?
fast they respond to you and that kind of thing.
There are a number of ways in which you can have a slow site. One is obviously the network may be slow. Another is your provider, your ISP may be slow. The site itself, if it's graphics heavy, could be slow. One useful little tool that you can discover by kind of cruising around the net is that there's a site now that will help you weigh the site of your broker so that you can determine how fast it is. So there are all kinds of tools and services on the internet to kind of help you speed up the responsiveness of the site that you're dealing with.
What's the site? What's the address?
It's actually at smartmoney.com. They have a little program that you can use to determine how fast your broker site is.
Okay.
It's pretty handy.
Andre, any thoughts about this as well?
Nothing, I wouldn't,
Okay.
nothing else to add.
Okay. Go ahead, sir. You have a question.
This is a question for each of the panel members. What is the single most precaution we should take when we hit that key on the slot machine? I mean the computer.
Are you talking about the execute machine, the execute button?
Right.
Andre, why don't you handle that one?
Make sure you've done your homework, that you know, I'm not sure if I'm interpreting the question the right way, but so that it's less like being at Vegas and more like investing. Make sure that you've done some homework and you really know what you're buying and you feel comfortable with the decision that you've made.
But Andrea, doesn't that bring up an important point, and that is that we have seen, this has been a bull market. We're in the longest bull market in history, and most online investors may not have ever seen a bear market, may not have experienced a severe correction in their portfolio, let alone the entire market. So are we setting everybody up here for unrealistic expectations?
I don't think so. I mean, none of us knows how long this bull market will last. And we have seen that in the pullbacks that we've had, that it's the individual investors that have been the most faithful, the most loyal. And I think we've done a good job educating people to invest for the long term and have a long-term horizon, regardless of the day traders out there. So I think with a bear market, we may see some slowdown in the growth of individual investing, but I agree with the comment that was made earlier that this is the switch has been flipped. That this trend will continue, and we'll see more and more people executing trading transactions online.
Okay, let's get another question in. Go ahead, sir. Oh, ma'am, I'm sorry.
I was wondering if you've heard of a site called stockwinners.com and what your opinions are.
What was it again? Stock what?
Stockwinners.
Stockwinners.com.
Don't know it.
I haven't heard of it, and so I can't really talk about it, but a site that has that name, stockwinners.com, is almost like buy this and make me rich now.com. I'd be really cautious about this, promotion issue and the stock touting issue. It may be a completely legitimate site with someone who has your best interests in mind, but it may not be. So really, I mean, the thing is, we talk about individual investors taking the initiative, and absolutely they are. But I think that, and this goes back to the chat room issue, what you're having is it's the same reason that, someone like Abby Cohen, who is a, very knowledgeable person and been absolutely right on the market for the large part, is still so popular. Even though we're doing the trades ourselves, we're still looking to other people to recommend things and tell us what to do. And in some cases, obviously, seeking that knowledge is absolutely right and the smart thing to do. But, on something like stockwinners.com or whatever, just be careful that, this isn't this isn't some kind of a scam.
Okay, we have just a few more seconds. Go ahead, sir.
Quick comment and a question. Of 2 years ago, in the first of this LA Times Investment Strategy Seminar, there was a question about how many people engage in online investing, and very, very few people. So we really have had a revolution the last couple of years. I think the audience, both television and in this room, would really appreciate your comments on the strengths and the weaknesses of maybe the top 5, 10 of the online brokerages, rather than to talk about just Gomez and we go ourselves. We'd like from you some indication of some strengths and weaknesses of 2 or 3 that you like.
Let me throw that to Bill. And I read, by the way, 1 in 7 investors are now online. Is that right, Bill?
1 in 7 trades in the entire market online. And I'll take that on and I'll say, look, there's 3 segments of the market. There's the high-end market, firms that are focused on branches, full-service product offerings. Who do I like there? I like Waterhouse and Charles Schwab. Great long-term firms that have been in business for a long time. If you want a full range, that's great. There's a mid-tier that's targeted at the active investor that really wants to invest online, doesn't want to pay an extra $10 or $20 a trade. Firms I like there, Ameritrade and E-Trade. And at the active trader end of the market, where what's important is speed and quality of execution, there's really one firm in that segment that dominates it, and it's StateTech Online. They do a great job. So those are the firms.
Okay. We're going to take a break. We're going to talk to our advisors a lot more about a lot of this stuff. But the first thing we want to talk about is day traders and the day traders phenomenon. So stay with us. You're watching CNBC on this Memorial Day. Welcome back. We're talking about investing online and using the internet to become a better informed investor with our 4 cyber experts. We have Bill Burnham, Tony Clark, Walter Hamilton, and also Andrea Williams. And I think I just misspoke. I said Tony Clark instead of Tony Cook. My apologies. We're going to begin with a question from you over here, so go ahead.
Which online trading is best equipped to handle after-hours trading when it's initiated?
It brings up a whole bunch of issues. Online trading after hours. Andrea, can you tackle that one? Do you have any familiarity with that?
I think you're probably better off.
Okay, go ahead.
I'd be happy to. I mean, after-hours trading is a really big topic nowadays. You know, obviously the issue has been, for many years, the institutions, through something known as Instinet, which is a unit of Reuters, have been able to trade stocks before the market opens, and more important, after the market closes. Obviously, companies will come out with their earnings releases or other releases in the minutes after the market closes. The institutions can then act on that trading, you know, buy it, sell it, what have you. The individuals obviously are on the sidelines until the next morning. You know, as with all the rapid change that's taking place, I mean, you've got both a number of non-brokerage firms, or at least up to this point, startups that have said, okay, we want to try and change that. You now have some of the brokerages themselves saying, okay, we're going to change that. Now you even have the you know, New York Stock Exchange and the NASDAQ saying, okay, we're going to start to trade after hours. Right now, really, individuals, and Bill can correct me if I'm mistaken, don't really have a mechanism to do that. Starting this summer, a couple of companies are going to try to offer that. One of them is called Eclipse Trading. They're based in New York. All they've said is sometime this summer we're going to offer something after hours. I believe it's going to be like 4 to 7 p.m. Our time.
Pacific time, you're saying?
Pacific time, yeah, Pacific time. A company called Witt Capital is also moving in that direction, and so are some of the online brokers themselves. They're hooking up with ECNs, electronic communications networks, to try and offer some of that. So it's not there now. It will be coming shortly. There are a whole bunch of things that are both good and bad about that we can talk about.
Well, let's talk about one element of that, and that is level 2 trading and information. And Bill, you and I were talking about this before the program started. You believe this information is going to be available to everybody by the end of the year. Why don't you explain, first of all, what is level 2 trading?
Yeah, most of you, when you invest in a stock, what you actually see, if you look at it, is there's 2 prices, a bid and an ask, what people are willing to buy the stock for and what they're willing to sell it for. And the quote is actually the last trade that's taken place. Now, what happens is on the NASDAQ market, you might have 10 or 15 different firms that want to buy a stock at one given time. And so you're only seeing in that bid, you're seeing the best price, but there's actually 10 or 15 other prices that are not as good as the best price that are being offered. That's what's called level 2, which is being able to see not just the best price, but all the prices. Very active traders like to see all the prices in the market, because you can tell if somebody goes from being the worst price to being the best price, that they really want to buy the stock, and that might be a sign that the stock is going up or down. So level 2 is very attractive to active traders, but for the average investor, level 2 really doesn't provide that much useful information.
And in one sentence, will it be available online to most people by the end of the year?
Yeah, it's available at only a couple of firms right now, but by the end of the year, anybody who wants to get access to it will be able to get access to it.
Okay, let's go over here. Go ahead, sir. You have a question?
Hi, my question is in regards to using Stock Screener online as a strategy in investing. And the question is, if you go online and you go to Stock Screener and you pull up a particular company that all analysts have rated a strong buy, does that mean it's a strong buy? Are they all right, or are half of them right and half of them wrong?
They're right until it sinks, right? And then they're wrong. You want to handle that, Tony?
Not necessarily. The nice thing about a site like Quicken.com is you can be your own analyst. You can see what other analysts are saying by looking at analyst research, which we provide for free for some analysis, and you can pay for it. Secondarily, you can actually use tools to do your own analysis. For example, on Quicken.com, you can do an analysis of 10,000 securities, some odd, and put in 33 different criteria to determine, when you've got your analyst hat on, what is suitable for you, what's the right one, what is promising in terms of the track record, and there's a lot of other information, charts, fundamental data, SEC information, and, by the way, the community opinion on a site where you can test other people's reaction to the stock that you're interested in as a way of making you feel confident that you're getting the right stock for you, and then you can hit the buy button and hopefully spell the ticker symbol correctly so you'll buy the right stock.
And that's important. Our television audience is going to take another break. When we come back, we'll take a closer look at the future of online investing, so don't go away. Welcome back to the Investment Summit here in Los Angeles, the convention center here in sunny LA. Quick question for Walter. To what extent are day traders influencing or playing a part in the volatility we see every day on Wall Street and on the NASDAQ?
I think they're playing a part. I think it's really stock specific more than it is the whole market. I mean, some of these internet stocks, absolutely, they're playing a huge role. I mean, what happens is, a company, this was especially a dynamic a couple of months ago, a company would come out, add .com to its name, or say, we're going to start a website. It really was irregardless of the company itself, what it did, whether it was making money, so forth. The day traders would jump on it. I mean, just jump on it. All that buying pressure zooms the stock in. Then you guys on CNBC report it. Then all the people in the audience here who are day trading would jump on it, and, you'd all of a sudden have a spike. Does it affect, the GMs and the Chryslers and the IBMs? No, not nearly as much. I mean, certainly it plays a role on some occasions. It's more so in the internet stocks, in the height of the fury.
When we say day traders, we really mean minute-by-minute traders, or second-by-second traders.
That's right. So, yeah, day traders is almost almost an insult to them now. They're second traders.
More questions from the audience. Go ahead, sir.
Yeah, my question was, are you talking about level 2 before? And I trade online a lot, and I always think I'm not getting the best bid and ask price. Is there a way, a site I can find where what trade group offers the best bid and ask prices?
Go ahead.
Yeah, level 2 is something that's gotten a lot of publicity now, and as Bill said, absolutely, there are a lot of just the regular brokers, such as E-Trade, will now offer you a level 2 screen, again, giving you all that list of order flow. I think they give it free for their most advanced traders who do, I believe it's 75 trades a month, I may be mistaken. All the others are going to start offering it. Now, level 2 is not a panacea by any stretch of the imagination. What it'll do is it'll give you a precise look at how the market is trading at the exact moment that you put your order in. Obviously, there's been a lot of criticism of some of the online brokers, some of it justified, some of it probably not because of the volume that they're getting. I'm putting in my order at 50, it's going off at 51, 52, 53, sometimes much higher. The level 2s are able to give you a real-time on the at the moment quote of the price, and then, you know, depending on how you've routed your order, you can then have a better idea of the execution that you're getting.
Okay, let's take another question over here. Go ahead, ma'am.
Thank you. Arthur Levitt this morning cautioned that if you place a trade at market, you run the risk of spending a lot more than you intended. Is there a way to get immediate confirmation that a trade was not only received but also placed?
Who wants to handle that one? Bill?
Well, I think almost all the firms today actually provide you two confirmations, when they receive it and when they execute it. And if it's a market order, they do indeed try to execute that as fast as possible. But it's important to understand that many of the online trading firms, in fact, most of them, actually take your trade and sell it to a third party before the trade is actually executed on the market. And when Arthur Levitt talks about you not getting a good execution on some of your orders, a lot of times it happens during that period of time that it's handed to this third party, and there is some questions about how faithfully those third parties execute trades. So perhaps the easiest way to do it is to eliminate the third party, and you can do that, or you can limit their ability to play with your trade by A, putting in a limit order, which specifies the price that you want to sell or buy the stock at, and B, there's some new ways to execute trades that are called ECNs, which actually do not have a third party in between, and therefore there's no risk of somebody playing hanky-panky with your trade.
Okay. Yes, ma'am. Go ahead.
Bill, as one of the panelists, you mentioned that you don't buy what you're writing about. So what I want to know is not what you're writing about, but what you're buying.
So what are you buying, Bill?
Well, you know, unfortunately, as an analyst, we actually have very strict rules about what we can buy and sell. For instance, if I buy a stock, I have to buy it for 6 months. I can't buy or sell it for 6 months. So in fact, I actually buy mutual funds, and I have the advantage of talking to a lot of the portfolio managers. So over time, I actually learn about the portfolio managers, which ones that I like and which ones I don't like, and I buy their mutual funds because it's a great way to do it. I own mutual funds from T. Rowe Price and from Janus right now, and that's just me, but I have to invest in mutual funds, and I actually don't invest in a lot of internet stocks because my job is essentially covering the internet, and if that blows up, I don't want to have both my investments and my job.
I've got 1 minute. I've got 1 minute left. Tony, I want to ask you, what is your perception of how quickly this is going to change this whole internet online investing phenomenon, and what do you expect over the next 6 months?
Well, this is a revolution, and it's happening, you know, at internet speed. And so in 6 months, I would say that the technology is taking us in the direction of greater visibility on trading, as we just discussed, more empowerment of people through tools that are customized and personalized for them, so that you can put in data about you and your position and get an answer that applies to you and that is sensible for your situation. And I think, you know, just the volume is going to be tremendous, and we're going to see 24-hour trading.
Andre, the democratization of trading continues and will even pick up, is what I'm trying to say?
Absolutely, I think so. It's going to get easier. The information's out there. The tools to be able to sort through the information and determine what's useful to you will get better.
We got to go. With that, it is time to log off this hour of our special program, the Investment Summit, the Los Angeles Times Investment Strategies Conference. We want to thank our panelists, Bill Burnham, he's the analyst with Credit Suisse First Boston, Tony Cook, the managing editor of Quicken.com, Walter Hamilton of the LA Times, and Andrea Williams, the analyst at Volpe Brown Wayland. Thanks all for joining us. Good discussion. And also thanks to our studio audience for participating. Great questions today. We appreciated that. Thank you for watching at home throughout today. We hope we've given you some investment strategies to make you a more successful investor online or otherwise. So long. Have a nice day.
to our special program, the Investment Summit. I'm Sue Herrera. We here at the huge Los Angeles Convention Center as part of an impressive two-day, third annual Los Angeles Times Investment Strategies Conference. You know, we here at CNBC and our colleagues at the Los Angeles Times are going to try to help you make money the way the pros do. Here to help us will be many of the most well-known and successful money managers and analysts in the country. During this hour, we'll ask some Wall Street gurus for their outlook on the economy, on interest rates, and the market overall. And then my colleague Maria Bartiromo will grill some of the growth stock pros about their top picks for the next decade. And we have Tom Costello with us as well. He will take a side trip, if you will, to look off the beaten track for some little-noticed investments. But we're not done yet. Then I'm going to be back to see whether or not big-name blue chips will continue to battle to the top of the market. And Maria will tackle the high-flying tech stocks. And last, but of course not least, Tom will log on to online investing and find out how to make the most of the net. So it promises to be a fascinating day with lots and lots of stock tips for you. So get out your pencils, your pad of paper. We're getting ready to strategize today. All right, let's start first of all with our agenda today. And first on the agenda is the big picture. Will our 8-year economic expansion and really almost the 9-year bull market continue, or are there indications that we're going to be in for a bumpy ride a little later on this year? Some would argue we've already had a bumpy enough ride this year. Here with all the answers you'll ever need are 4 Wall Street gurus. First, we'll start out with William Miller. He is the president of Legg Mason Fund Advisor in Baltimore, and he has responsibility for investing about $20 billion in assets. And his Legg Mason Value Trust Fund has a 5-year average annual return of almost 37%. Not bad, huh? Next to him is contrarian value manager Robert Rodriguez, who is the principal of First Pacific Advisors right here in beautiful Los Angeles, my hometown. His FPA Capital Fund has a 5-year average annual return of almost 22%, and his FPA New Income Bond Fund has a return of 7.5%. Next to him, we have the very well-known market timer, Bernie Schaefer. He is chairman of Schaefer's Investment Research, located in Cincinnati. He's also the author of a book, great book, The Option Advisor, Wealth Building Techniques Using Equity and Index Options, something that a lot of us can learn more about in this particular market. And last but certainly not least, holding down the fort at the other end of the stage is Ralph Wanger. He is the Chief Investment Officer of Wanger Asset Management in Chicago, and Ralph's $3 billion Acorn Fund has a 5-year average annual return of 15.5%, and he is also an author of a book, A Zebra in Lion Country. And it's out in paperback. It's good to see all of you again. Welcome. It's great to have you all here, and it's great to have all of you here. Thank you so much for coming. I think it's going to be a great hour or so, and we have a lot to talk about. Let's start, first of all, with the big picture. And Bill, because you're right next to me, I think we'll start with you and kind of work down a little bit. We mentioned we're in the 9th year of the bull market. It's gotten very choppy lately. 8 year of economic expansion. Do you anticipate that this is going to continue, or do you think that the choppiness that we've been seeing lately is indicative of the top?
Well, I certainly wouldn't have any idea whether we're at a top or not. Choppiness is indicative of, or normal in any type of market. Last year we had a 25% decline from peak to trough, and the year before that we had 2 10% declines. And the market looks okay to me. It doesn't look great because it looks properly priced given the fundamentals, but the economy looks fine. We have good economic growth. Inflation's low. So the economy looks good, the market looks okay, but I wouldn't expect it to shoot up from here particularly.
Bob?
What I have to say is that everybody talks about the market, but there's several markets.
Yeah, you're an advocate of multiple markets.
And what happens is right now, I would say the broader market is in a process of recovery from its underperformance last year versus some of the larger cap stocks. So I think you have to break it down between markets. In terms of the economy, we see it still continuing to grow very robustly, and the likelihood is that the international situation starts to kick in sometime over the next 12 months. So I think probably the biggest fear we might have to have is possibly what we'll get into in terms of, let's say, inflation risk.
Inflation and interest rates. We're going to talk about those in a second. Ralph, you also are kind of an advocate, and Bernie, I'll get to you in a second, but Ralph, you're also an advocate of the multiple market theory, are you not?
Well, that's correct. There's some very interesting problems we have to settle in this group. I'm glad we're here because
We've seen the broad market go to 28 times earnings, say, on the Russell 1000 index, which is the highest it's ever been, about close to double its long-term average. At the same time, the Russell 2000 index, which is where our small cap managers live, has PE of only 18 times. That spread of 28 to 18 is extraordinary. And if you look at the last 20 years, over almost all the times the small caps had a higher PE than the big. This is a reversal of the normal pattern. And why is that? And what's going to happen next? And I think you can argue that for the last 6 months, small cap have actually been finally doing as well as or better than large companies, and maybe the turn is here.
Bernie, you use a lot of technical indicators in your particular work. How does what you're hearing here on the panel play into what you're seeing on the charts?
Well, of course, we've come a long way since last October in terms of the sentiment indicators that we track very carefully. Back in October, we were at a real climactic market bottoming, booming, screaming buy type of situation from a combination of the technicals and the sentiment. We've come a long way since then, but it still strikes me as kind of remarkable because when you're trying to divine whether you're at a top or not, you're trying to see whether you're at extremes in a lot of investor sentiment-based analysis, and it kind of strikes me as kind of remarkable that we're seeing actually about half the mutual fund inflows into equity funds in 1999 as we saw in the same period in 98. We've had 10 times as much money go into money market funds in 1999 as has gone into equity funds. And we're still seeing the option player as represented by the index option trader still playing the crash scenario as the primary motivating factor as opposed to getting greedy and playing for the big move to the upside. So from that standpoint, although we could remain pretty choppy for the next few months, we've got the Fed out there, which we're going to talk about a little bit later.
Yeah, I was going to say, you're going into the next segment, Bernie.
but from the standpoint of do we have all the factors in place from investor sentiment to be at a big market top, the answer would be no.
Let's talk a little bit in the time that we have remaining before this break about growth versus value. Bill, should there be a distinction in this particular market between what we consider growth and what we consider value?
Well, I agree with Charlie Munger, Warren Buffett's partner, that the whole distinction is what he calls twaddle. I mean, those are terms that don't really carve the investment universe at the joints. They're terms that are applied mainly by consultants. From where we sit, we're trying to always figure out where the best values are in the market, whether they're in growth stocks or whether they're in companies that aren't growing, and we're really valuing businesses and not trying to guess which stock group is going to do better over time.
Bob, you were nodding your head in agreement.
Most definitely. It's I get a kick out of looking at one consultant's work where they allocate on a stock, whether it's value or growth, and on a particular stock they might have 57.2% as growth and the residual being value, and they shift it up and down. And so, for example, a company that we were involved with, Lamb Research, 2 years ago was selling at close to $70 a share, which would be a growth stock valuation, but then last fall selling at $10 a share. You know, it's still the same company, but a different description of what the company is in terms of these consultants.
We're going to take a quick break. We have a lot more to talk about, but we are going to go to a break, and then when we come back, while the market does look pretty good right now, there's one factor on the horizon that might change things. We will talk about that interesting topic, there's a hint, right after this. So stay tuned for much more of our special program, the Investment Summit Conference of the Los Angeles Times Investment Strategy Conference. Back in a minute. Welcome back to our special program, the Investment Summit. I'm Sue Herrera, and during this hour, we are assessing the direction of the market and the economy with a panel of Wall Street gurus. Joining us, Bill Miller with Legg Mason, Robert Rodriguez, head of FPA Funds, market timer Bernie Schaefer, and Ralph Wanger, manager of the Acorn Fund. Welcome back, gentlemen. We have a lot to talk about. Before the break, we were talking a little bit about growth versus value. We gave the big picture of the economy and in general what you saw, but things changed, it seems, a little bit just the other day when the Fed made its quasi-move, if you will. They moved to tighten and change their bias, or change their bias and not tighten, perhaps better said. Let's get your thoughts on whether or not that changes the dynamics of the market right now. Bill, I'll start with you just because we're going to go in order. So
I don't think it has any impact. The Fed is following the markets. They're not leading the markets now. The long bond is backed up significantly since last October, and I think the Fed is just recognizing that after their 3 interest rate cuts last fall, that with the current state of the economy, that neutrality or even an eased bias is no longer necessary. But that can change. They had a tightening bias last year up until the time that they eased.
Mm-hmm. So it's just never an easy way to figure out that Fed. Bob, does it change your approach to the market and investing?
I would say it's add an element of risk to the marketplace from the standpoint that as long bond starts to move closer to 6%, the competitiveness of bonds vis-a-vis stocks starts to get considerably closer together.
So is the 6% handle really important to you?
I'd say we pick one stock at a time, but I think from a general market standpoint and asset allocation models, that as should the bond go through 6%, I think it could trigger some asset allocation shifts in pension plans, and that could have an impact on the marketplace.
And Bernie?
Well, Greenspan makes me nervous generally when he makes pronouncements about concerns about economic growth and potential inflation. Of course, that was compounded by the CPI number. But interestingly enough, we've actually been through a period where stocks and bonds have been going in the opposite direction. We actually had the peak in interest rates around July of last year, and as interest rates kept coming down through September, October, of course, and bonds were going up, stocks were going down, and of course, then we had a situation where bond yields bottomed in October, have been doing nothing but going up ever since, and that has been accompanied by nothing but rising stock prices. So that stock-bond correlation has kind of dissipated a bit, although I do think, as Bob was saying, 6% is, above 6% might be a bit of a concern.
But 6% historically is still pretty darn good compared to where we have been in interest rates. Is it just that we're so used to a low interest rate environment?
I'm scared to pre-1987 crash. We were moving into double-digit levels on interest rates, and in addition, the dollar was plunging. And another interesting thing that I'm finding is post-Greenspan speech, and even post-CPI number, we've experienced a huge plunge in gold to multi-year lows. Crude oil has come off significantly from its top. The dollar has strengthened significantly. These are all certainly not consistent with an inflationary environment. Utility stocks have rallied sharply. The Dow Utilities just made an all-time high. So if you're looking at it from a technical standpoint in terms of the indicators that are associated with rising interest rates and rising inflation, those indicators have actually experienced a major setback in the last few weeks.
I haven't forgotten you, Ralph. You're right there. What do you think?
Well, there's some amazing things going on. For instance, for the last couple of years, for the first time one could think of, the 10-year bond rate in the U.S. is higher than the bond rate in Italy. So we have to pay more for money than the Italians, which is something which would have been hard to predict a few years ago. I think bond yields at these levels are very competitive with stocks, and given growth stocks at high multiples. And for people who are looking at long-term asset allocation, I don't think it's a bad time to do some of their bond buying.
Now, Bob, you have an expertise in that particular area. Is now the time to buy bonds?
I'd say it's a time to start gradually scaling into the bond area. I think one of the elements that's probably a subtlety here, and that is why 6% is such an important level.
Exactly.
And this is a debatable point. Some of us believe that the long-term returns on stock prices are going to be coming down. You cannot compound at 30% rates of return in the S&P when corporate profits are growing at 5 to 7%. So if returns on stocks migrate down to the growth in earnings, let's say on the S&P, in that 5 to 7% range, a bond yield of 6% is very competitive to that range.
Would you go out to the 30, or would you go to the intermediate part of the curve?
I'm still standing right now in my bond fund. We have about 37% of the portfolio in inflation index bonds, and we've considered them among the cheapest high-quality securities in the bond market for some time. We would wait somewhat longer. We'd like to see yields test that 6 and go through 6, quite honestly, before we would really extend our maturities.
And Bill, would you be willing to dabble in the intermediate part of the curve for the longer end, or are you sticking with equities?
Well, we're primarily equity investors. We will do bonds occasionally during extreme points in time. But I do agree with Bob that bonds at 6% are quite competitive with the long-term rates of return on stocks from here.
All right, on that note, gentlemen, we're going to take another quick break, and then we'll be back with much more. When we do come back, we'll start picking stocks. No pressure, guys. Our guru panel will have their top picks and pans for you right after a quick break. Back in a minute. Welcome back. We continue our special holiday program, the Investment Summit, coverage of the LA Times Investment Strategies Conference. I'm Sue Herrera, and I'm joined by a panel of gurus from Wall Street. Bill Miller joins us, Robert Rodriguez, Bernie Schaefer, and Ralph Wanger. A great panel to give you some picks and perhaps some pans in this market environment. And Bill, you got the lucky seat. You're first.
Could always start on that side, Sue.
You know, maybe next time I will, because poor Ralph is over there on the other side. Well, let's start with what your favorite sector is right now, if you can do sectors. I don't know whether in this environment in the market you choose sectors or whether you still are doing individual stocks.
We don't think top-down from a sector standpoint. We do individual companies, but that said, our two biggest weightings are in financial services and in technology.
Even with the Fed's bias change?
We do something which I guess most people don't do today, which is we actually invest for the long term. So our average holding period is...
You mean 2 days? You hold for 2 whole days?
Our average holding period is 7 to 10 years. So what the Fed does this month or next year doesn't make a whole lot of difference.
It doesn't even matter who's Fed chief in your book, does it?
That's right. Not much. Not much.
Any particular names in the financials?
Oh, sure. Well, the market today, even with Ralph's corrected 28 times earnings, there are a lot of things out there that are really cheap.
Get your pencils ready.
Bank One, we think will make $450 next year. We think they have a great internet strategy. We think it's trading around $60. We think it's worth $90. Washington Mutual trades around $40. It's a big West Coast financial institution. Kerry Killinger's been a great wealth creator for 15 years. We think that's worth $60. Toys R Us is if you want a pairs trade, eToys came public with 25.
Tell people what pairs trading is first.
Oh, that would be a pairs trade would be shorting one part and going long the other part.
Okay.
But eToys came public last week with $25 million of revenue, trailing revenue, and a $8 billion market value. We're long Toys R Us, which has $11 billion of revenue and a $4 billion market value, and we think that that's a little better bet.
All right, let's move on to you, Bob. How are you playing this market?
My two largest sectors in the fund today are in technology and retailing.
Are you a .com guy?
Well, I've had some comments recently where I find it rather impossible to connect the term investment and internet together, that it's, in my opinion, it's a new oxymoron.
There's some pretty wealthy oxymorons out there these days.
Yeah, a friend of mine says, will you quit panning the internet stocks?
And does he hold them?
She does hold some.
She does hold them.
But anyway, it's, no, we're not involved with any of those. We've had some beneficiaries, for example, in the case of Consolidated Stores, which owns McFrugal's and Odd Lot, Big Lots, and KB Toys. And KB Toys is doing a relationship with this Brainplay, and they're going to create a new internet combination that would be a competitor of eToys that just came out. And you look at the valuation of eToys at $8 billion and a valuation on Consolidated Stores at $3.8 billion, and KB Toys is like number 3 in the business. Kind of wonder, say, well, is there something, maybe a little bit of a misstatement here.
Yeah.
But in terms of individual stocks, our most recent purchase was a company by the name of Hutchinson Technology that collapsed from $45, $50 range. They raised about $220 million in cash just about 9 weeks ago, and it collapsed down to 20. And they make, they're a participant in the storage area, in the disk drive area. In the retailing area, we have recently acquired an even larger position in Michael's Stores, which is in the arts and crafts area.
I've been there many times. Bernie, I want to get Bernie and Ralph in.
Okay.
Bernie, how are you doing it? How are you playing the
I'll
market?
give you a little .com stuff, but maybe not directly .com. My favorite stock, and it's been the case for a while, is Charles Schwab.
Mm-hmm.
And you know, here you have a situation. They're not completely internet, obviously. They've got a mixture of internet and brick and mortar. But here you have a situation where, if you just look at the numbers, if you look at their the hits on their website, for example, have gone from 12 million first quarter of &98 to 50 million first quarter of '99. Sequential commission revenue income, April of 1999 up 30-some-odd% over March of 1999. I mean, you're talking significant growth. Now, what we look for in conjunction with industry leadership, strong fundamentals, strong technicals, is a little bit of a twist where there's a lot of skepticism that we're seeing from some of the indicators we look at.
Mm-hmm.
With regard to Schwab, very little activity from call option speculators. Only 7 analysts cover the stock. And I don't know if there's anybody here from Barron's or not, but they are on Barron's list of the most overpriced / or in parentheses, stocks to short. Those stocks, when they have been strong technically,
Mm-hmm.
have tended to be good plays for the next 6 months to a year.
Ralph, you got the last minute.
Okay, well, we've had some fun going overseas and finding companies which have done well in the U.S. and then finding something just like them in some other place where they might be cheaper or in a different part of their growth cycle. For instance, everybody wants to do internet stocks, the Yahoos and the E-Trades. There's a company in Japan called SoftBank, which owns 31% of Yahoo, big hunks of E-Trade, dominates the whole internet picture in Japan in a way that no U.S. company does. It's really interesting. Similarly, one of my great stocks in the U.S. has been Harley-Davidson over the years.
Hold that thought, Ralph. I'm not giving you the hook. I'll be back with you in a second. We're going to take a quick break. When we come back, we will take questions from our audience, and we will get sectors that the gurus on our panel like. Back in a minute. And welcome back to our special holiday program, the Investment Summit. I'm Sue Herrera. Throughout the whole day today, we're going to be bringing you the best and the brightest at the 3rd Annual Los Angeles Times Investment Strategies Conference. A little bit later on today, we're going to spend a lot of time on picking tech stocks and blue chip growth stocks and using the web. But during this hour, we're looking at the overall direction of the market and building a broad portfolio. Our guest gurus are Bill Miller of the Legg Mason Value Trust Fund, Robert Rodriguez with the FPA Funds, market timer Bernie Schaefer, and noted author, I might add. And right at the end, anchoring the whole panel for us, is Ralph Wanger, manager of the Acorn Fund. And Ralph, before the break, you didn't get a chance to finish off on Harley-Davidson.
Well, Harley makes the best cruising bike in the country, but the
Do
best...
you know that from personal experience, Ralph?
Well, I've watched a lot of them. I'm not a big biker, but I admire the people who do. But the best racing bike in the world is undoubtedly the Ducati, which has just gone public. And that's so if you've made money on Harley, maybe Ducati's the next
Ducati?
right.
Do you know the symbol?
DMH is for the ADRs.
DMH for the ADRs, okay.
Similarly, we've made a lot of money on international game technology, which dominates the slot machine business in this country. But the same dominance in Australia is a company called Aristocrat. So there are lots of ways that you can take your knowledge of the U.S. and take it into foreign countries and pick up some good stocks there. It sometimes comes back the other direction.
Yeah. We're going to take questions now from the audience. We have a lot of questions, and we're going to start right over here. What's your question, please?
My question has to do with index investing, internet stocks, and the end of June. And the Russell 2000, as you know, is made up of lots of internet stocks that have appreciated significantly. in the last 9 months or so. The end of June, they're going to go away and be replaced, and as a consequence, I think the Russell 2000 is expected to go down about 6% overnight. Do you have any comment on what that might do with internet evaluations?
Ralph?
I don't think it would work that way. You'd re-index it, and I don't think you'll see any one-day change in the index. The future growth rate of certainly would be different without the internet stocks. It might be a lot better, though some of those stocks can go down as well as up, in theory. I've never seen it happen, but it might.
Any other thoughts?
Well,
Go ahead, Bernie.
Just from a technical standpoint on the Russell 2000, something really interesting has occurred this year. Russell, by the way, we measure bull and bear markets. One key indicator is long-term moving average, the 20-month moving average. Russell moved below its 20-month moving average back last July, and then has struggled and has finally surpassed that long-term moving average about a month ago. Translated into English, that means it's moved from a bear market status to a bull market status, which is kind of interesting given how old this bull market is overall, that we have a broad index like the Russell, which has actually moved from bear into bull mode. And I think there are a lot of opportunities out there in the smaller cap area.
All right, let's take a question from this side. Go ahead.
Great panel, thank you.
Thank
My
you.
question is directed to Mr. Miller. Lately, the pharmaceuticals have been treading water, and I'm just wondering what your opinion is as to whether or not you think that price controls will be imposed on the drugs, and whether you think that there's a bright future for the pharmaceuticals in view of that, particularly Pfizer. Thank you.
We don't own much in the way of drug stocks. The only one is Amgen. The drug stocks are great companies. By and large, they've been too expensive for us, although now, with the correction, I think many of them are trading at lower multiples than the oil stocks, and we definitely don't like the oil stocks. I don't think there's going to be price controls on drugs. The CEO of Amgen came in to see us a few weeks ago, and one of the points that he made was that pertains to your question, that there are only a couple of areas in the market or in the economy where there's sort of unlimited demand. One of them is for better vacations, and the other is for better health care. and the drug stocks are fine long-term. Pfizer's the most expensive, but it's a great company.
Any other thoughts on the drug stocks? And then I want to ask you why you don't like oil stocks, because you left that gaping hole right there. You said you definitely don't like oil
They're
stocks.
awful.
Now I've got to ask.
Awful.
Could you elaborate on their awful?
I think that most money managers, and especially many value managers, have a predilection for these things, and I can't figure out why that is. Only because they were imprinted like baby ducklings when they came into the market in the early 70s, when oil prices did nothing but go up. But commodity prices in general decline in real terms forever, and oil is no exception. It's had a bounce right here in the last 3 or 4 months, but these companies trade at very high valuations with very low growth rates. There's very little demand growth, and pricing is unpredictable. Other than that, they're great.
So you don't like them. All right. Other than that, they're great. All right,
Just a counterpoint on
Sure,
that.
go ahead.
A counterpoint on that is that there are areas in the energy sector that you can play, and there are companies that have been very profitable. Now, we're involved with one called ENSCO International that has been a very profitable company in terms of returns on assets, returns on equity, and back in February, the stock got down to basically book value, 1/3 of replacement value of the rigs. Literally, you could shut them down and liquidate the company. And so you have to be a little bit careful, but I'd say the larger companies tend to be rich.
We're going to try and get in a question right over here. Go ahead.
In the next 6 to 9 months, how do you think Y2K may affect the stock market?
Who wants it? Oh, they're pointing fingers. Go ahead, Ralph. You raised your hand.
Okay, well, most of the U.S. companies are pretty well through the bulk of their spending on Y2K, and actually we are seeing a reduction in the amount that companies are spending on Y2K programming right now. This has caused some of the consulting companies who have worked on Y2K to have a sort of slowdown in that part of the business, but they're starting to get a build-up in their more conventional business. So we think for the IT industry, that Y2K has actually sucked money out of a lot of constructive projects, and those projects will start kicking in again next year. So I think we'll see actually some good results in companies such as Keen and Computer Task Force. I don't think U.S. companies are going to be too embarrassed when the calendar turns. I'm a little more nervous about some companies outside the U.S., and I'm concerned about government at both federal, state, and local levels as whether they are completely prepared. So there could be some disruptions.
Okay.
So, you know, make sure you're with somebody you like real well and on New Year's, and have a case of champagne and some canned peas and wait it out.
And wait it out. All right, we'll take a quick break, and then we're going to take more questions from our audience in just a minute. We'll continue in just a moment. Welcome back. We are going to be taking more questions from the audience and then perhaps talking a little bit about the technology stocks. Our guru panel is here to give you the best possible investment advice today. Let's start and go back with the audience questions with a question right over here from this gentleman. Welcome.
Thank you. My question is to Mr. Miller. Given the fact that your portfolio has an average holding of, say, 8 to 10 years, I'd be interested in your comments concerning Warren Buffett's Berkshire Hathaway. Berkshire, as you know, is a holding company which holds its stocks indefinitely. And I was wondering if Legg Mason Value has a position in Berkshire, and if so, what is your opinion of that holding company?
We own Berkshire. We're one of the larger institutional holders of Berkshire. Trades around, $75,000, $76,000 a share. As I said, we value businesses and not stocks. As a business, as a collection of businesses, we believe it's worth $90,000 to $95,000 a share. So it's a remarkable opportunity to get one of the great wealth creators in world history at a discount.
At a discount. You know, I'm going to have to take you shopping with me. I love your idea of a sale. My husband won't like it, but let's go over here and take a question right here. Go ahead.
Hi, on the theme of shopping, I'm always curious why inflation is counted as being so low, because as consumer prices seem to go up. For example, rents, housing prices, gasoline, food, drugs. So could you explain for me?
Bob, you want to take that?
Well, I mean, it's in the, shall we say, in the government's interest to have the CPI index low. They've been reformulating the index for the last couple of years, and there's a number of measures or payments that go to the consumer off the CPI. But your market basket of goods that you're shopping for may not reflect the market basket of goods that are measured in the CPI. And approximately 40% of the CPI has commodity prices in there. So that would not be reflective of possibly what you're shopping for.
Also, the cost of living on either coast, Los Angeles and New York, versus the cost of living in the heartland of the country. I mean, I know after living in Los Angeles, it's expensive in a lot of ways. So the CPI is almost skewed, is it not?
It is skewed, but I mean, you can go to different parts of the country and you can even see it, let's say, in how the government allocates for, shall we say, welfare payments. You know, in one area here, a new entrant might get $450, but if you go to Mississippi, it's like $135 a month. And so there's this regional difference here.
Then why does the market pay so much attention to it?
Because we're investing in companies that are more than just one regional area.
All right, let's go back to the questions and take a question from right over here.
I'm talking to a whole panel. I'm interested in currently undervalued stocks which have a potential in the future. Do you have any suggestions?
Undervalued stocks.
May I make one question?
Sir.
I have never met a manager yet on any of these panels or anybody else out in the audience that has ever wanted to buy overvalued stocks.
I don't know. He's talking Berkshire Hathaway at $70,000 bucks. I don't.
Except the technicians, they like to buy over.
Oh, is that it? It's always the technician's fault, isn't it?
Yeah, let's shoot them.
All right, let's start. Ralph, we'll start with you. Undervalued stocks. You named a couple that you liked outside of the country. What about domestically?
Well, there are lots of great companies here. I've been buying some sweat stocks. One
Sweat stocks?
Yeah, one where you pay to sweat, Valley Total Fitness. And another one where
You're not sweating at your investment.
and another way, sometimes. And the other one is Labor Ready, which is a employment, does temporary help employment agencies, and there people go and get paid to sweat. So they've both been growing very fast and doing quite well. So those are two
Okay.
undervalued companies.
What about Bernie? What are you looking at?
And sweat it out.
Well, there is actually a solid value stock from my perspective that looks pretty good technically here. AMR, the airline holding company. Interesting situation, selling at about 10 times earnings. Earnings expected to grow approximately 10%. The airline sector got hit very hard in the market pullback from mid-year last year, almost got cut by about 50%, and it's recovered about half of that loss, but it's still very reasonably priced and still in bull market status. The interesting thing about AMR, besides the fact that it's got a pretty decent core business, is that they have an 82% interest in Sabre, and Sabre has as its subsidiary company called Travelocity.com, which is
You are a .com guy.
which is in the realm of, in terms of what it does in the airline side of the business with what companies like Priceline are doing. Bottom line is AMR has a market cap of about $11 billion. AMR's stake in Priceline is currently worth in the market about $6 billion. So you've got only about $5 billion valuation actually for AMR's airline business, and plus you get a little bit of a, or maybe a lot of a kicker from the internet side, including the possibility of a spin-off from Sabre of the website.
Bob, how do you, I think one thing that we need to talk about just briefly is how do you define undervalued?
That's a good question, because everybody has a different way, a different, shall we say, recipe. In my case, we tend to look at companies on various valuation measures, such as PE, price to book, market cap to revenues, price to cash flow and free cash flow. So we like to look at a company on a number of different measures. And then another way of going at it is I've always found that it's find a market leadership company in an industry that people hate or is unloved, and again you find generally a value there. Market leaders have a tendency not to go away. So for example, one company that we're involved with that's a play on computers and electronic growth is in the capacitor area, Chemet and AVX. Chemet is getting squeezed by prices coming down from Japan and costs that went up from commodities. They've squeezed their profitability. That's in the process of reversing, and yet the stock's down about 70% and not much above book, and is one of the market leaders in the industry.
All right, on that note, we're going to take a quick break once again, and when we come back, we'll take more questions from our audience. So stay tuned. We have a lot more of the Los Angeles Times Investment Strategies Conference right here on CNBC. Welcome back. We want to get right back to more questions for our guru panel from our studio audience, and we're going to start right over here. Go ahead, please.
Hi. In recent months, the market has been able to shore off political conflicts at home and abroad. Do you see any scenario in the future which could trigger a major sell-off?
The political problems in the world unsettling Wall Street. Who wants it? Okay.
I'll take that one.
You want to take it, Bob? Go ahead.
I was trying to give it to Bill.
I know. Bill's just sitting there going, not me, not taking that question.
We rarely ever think about that as a driver in our investments because we're picking companies one at a time. But I would say the disruptions overseas that are occurring are showing have some corollaries, and that would be is the potential impact on our own budget here in the United States from increased defense spending coming in conjunction with the potential for rising transfer payments in terms of the entitlements area. And so we've been underinvesting on the defense side, and that has benefited the budget of the U.S. Now, if that creates more problems around, that could put stress on the budget and raise a question for the financial markets, especially the debt markets.
Now, Bill, you invest 7 to 10 years, so doesn't factor into your book?
Well, there's a difference between short-term market declines that are caused by external factors, which are typically buying opportunities, and then true bear markets. And you only get true bear markets when things go really badly wrong with the economy. You know, in 81, 82 with inflation, or 73, 74, 1990 we had a recession and a war. But that's the only time you really get serious, long-lasting problems.
Bernie?
Interesting in terms of the question, because I think the question is very, very typical in terms of the fact that there is concern. A lot of things, of course, can derail a market at any given point in time or over any 6-month period. But I think we were talking very early on about, are we at a market top potentially? And again, I think as long as the focus is what could potentially derail this market, and I think that is what the focus is, we're not at a market top, because at market tops, the focus becomes, when is the Dow going to 20,000? Haven't heard that question yet, although maybe it's coming up.
But we do have some people that we interview on CNBC who are saying that we've got Dow 18,000. Do you know how many specials I'm going to have to do if we get Dow 18,000? Especially if we keep going the way we're going now. There are those who are projecting that. Is that over-enthusiastic, or is that sign of a top?
I think they're relatively few. You know, we see Investors Intelligence poll has 60% bulls, which has historically been a short-term concern for the market. We see the brokerage firms' asset allocations in the area of about 60% for stocks, which has historically been high, but the targets of those who are bullish are extremely modest. Barron's very recently had a bull on the cover of the magazine, and if you go into the article about the money managers who were being polled, their target for the Dow for 1999 was 10,800. So I think there are bulls out there, but I think basically the targets are very modest, and the expectation, particularly among the option traders that we track, is more of when is this thing going to crash than when is this thing going to double or triple.
Let's take a question from right over here. Go ahead.
My question is, I would like to know what is the best advice or advices you could give to a person who just started in the market like me? And is it a good time to get into the stock market at this time?
Well, congratulations for starting, and welcome, because this is a great conference for you to get some tips. What's the best advice? Ralph, why don't you start us out on that?
Well, I'm going to say what I think I can get agreement on the panel with. For a beginning investor, mutual funds are certainly the best way to start. They give you a diversified portfolio. They will give you information which will help you learn more about investing. And they will give also very good results. Certainly Bill and Bob have had great results, and our Acorn Fund has done fine, so go mutual funds.
What about knowing what kind of an investor you are? Because it's very confusing in this market environment.
Well, it's very important to know your risk tolerance. When you've had a bull market for several years, it's very easy to think that you are very brave. The problem is when things start going the other direction, are you really as brave as you thought? So it's there's a bit of a psychological trap in this kind of good market.
Would you agree, Bill?
I agree with everything Ralph said. I think it's critically important to understand your objectives, your time horizon, your risk tolerance. I think for the average investor, the average mutual fund manager, for that matter, trades way too much and owns way too many stocks. I think you need to be long-term and patient and optimistic and set an investment policy and stick to it.
Bob?
I would say really look into yourself about what your risk makeup is. How is it to lose money? It's not, most people really lose their performance not on the upside, they lose it on the downside. It's when they get panicked out of a situation. And usually they get panicked out of a situation because they don't understand what they own, either the individual security or the mutual fund. And many times I ask individual investors, who manages your fund? And they say, well, it's, and they give a large corporate name. I said, no, who is the individual? and what does he represent or her represent in the fund.
Gentlemen, thank you so much. We're going to have to wrap it up. It went all too quickly. That is basically all the time we have for this hour of the Investment Summit. We want to thank our panel of Wall Street gurus, Bill Miller of Legg Mason Funds, Robert Rodriguez of FPA Funds, Bernie Schaefer, Chairman of Schaefer's Investment Research, and Ralph Wanger, Chief Investment Officer of Wanger Asset Management. And thank all of you for joining us, but don't go away. There's still a lot more ahead today from the Los Angeles Times Investment Strategies Conference. Coming up next, my colleague Maria Bartiromo goes for the growth with the Growth Fund.
Hello and welcome to this hour of our special program, the Investment Summit, the third annual LA Times Investment Strategies Conference. I'm Maria Bartiromo. Throughout today, we at CNBC and our colleagues at the Los Angeles Times are tapping into the investment strategies of top market gurus, from indexing to bonds to investing in the high-flying internet sector. During this hour, we are going for growth. For the last 2 or 3 years, growth stocks like Microsoft and Pfizer and MCI WorldCom have been the darlings of Wall Street. But recently, the tide has turned. Growth stocks soared more than 40% last year, but on average are up less than 6% so far this year, while value stocks are up more than 13%. So is the party over for growth stocks? Joining me here on stage are 3 top-rated growth fund managers who say no way. First is Ron Ogner. He's the portfolio manager of several funds for the Strong Capital Management in Milwaukee, including the Strong Growth Fund, which has a 5-year average annual return of 25%. Next to him, John Schroer. He's the manager of Invesco's Health Sciences portfolio in Denver. His Invesco Health Sciences Fund has a 5-year average annual return of 24.5%. And on the end, Garrett Van Wagner. Garrett is president of Van Wagner Capital Management in San Francisco. His flagship Van Wagner Emerging Growth Fund has a 3-year average annual return of 8%, but an impressive 1-year return of 70%. Welcome to all of you. Thanks for being here. Let me begin with you, Ron. Is the party over for growth stocks?
Well, I don't think it's ever over for growth stocks, but we're going to take a pause here as interest rates climb and the economy speeds up, and therefore more cyclical companies can show better earnings. But I think the game is starting to swing towards the more mid-cap and smaller cap growth stocks.
So should investors be rotating their money into some of those cyclical stocks, do you think, that aren't considered growth?
You should do more new buying in the mid-cap area and some of the cyclical sort of time being, but you've got to wait now. You're getting opportunities in some of the bigger, better-run companies that are finally coming down in price.
John, what do you think? Is value in it these days or growth?